Welcome to another educational case study by Blueprint to Escape.
Glad to be here.
Today we are exploring the educational case study titled The Essentials of Financial Options and Covered Call ETFs.
All right.
And, what if I told you that intentionally limiting how much money your portfolio could make is actually kind of the secret to surviving retirement?
Yeah, it sounds completely counterintuitive when you first hear it.
It really does. I mean, we spend our whole lives conditioned to chase maximum growth.
Exactly. But then you cross a certain threshold, say, your 40s or beyond, and the rules of the game change entirely.
It's a pretty profound shift.
It is. The tools that originate in these highly speculative, chaotic trading floors suddenly need to be repurposed.
Right, like we stop using them to chase explosive high-stakes jackpots.
Exactly. Instead, we engineer them to build an engine for steady, predictable cash flow. It's the absolute definition of shifting from a growth mindset to an income mindset.
Well, before we jump into those mechanics, just a brief note that this educational case study is for educational and entertainment purposes only. It's not financial, tax, personal, or investment advice. It is always wise to speak with a licensed professional before making investment decisions, just to ensure it aligns with your specific situation.
Yeah, definitely a good idea.
And also, any specific companies or ETFs we mentioned today are strictly for research purposes. They are not official sponsors.
Right. So our mission for this educational case study is pretty straightforward. First, we need to thoroughly understand the foundational mechanics of a financial option.
The basics.
Exactly. And second, we want to explore its practical application through covered call ETFs.
Yeah. And we are specifically framing this analysis around the needs of you, the investor aged 40 and older.
Because at this stage in life, your focus naturally pivots. You're likely stepping back from aggressive growth and looking to generate reliable passive income without having to sell off your core portfolio assets.
So, keeping that in mind, our tone today is going to remain calm, measured, and highly informative.
No overexcited, hype-bro finance jargon here.
Exactly. None of that. We are just going to look at the clear, steady analysis of the math and mechanics at play.
Sounds like a plan.
Okay, let's unpack this, starting with the foundation. Assuming you have a passing familiarity with the market, let's do a rapid-fire refresher on what a financial option actually is.
Right.
The educational case study defines it as a derivative contract that gives its buyer a specific right, but not the obligation, to buy or sell an underlying asset at a fixed price by a specific date.
Yeah, and the operative phrase there is right, but not the obligation.
That's the key.
It really is. That is the hinge upon which this entire strategy turns. Just to logically categorize the terminology for our baseline.
Please do.
A call option gives the buyer the right to buy. A put option gives the buyer the right to sell.
And the pre-agreed price they lock in, that's the strike price, right?
Exactly. While the hard deadline is the expiration date.
Right. And finally, there's the premium, which is the actual cash cost the buyer pays to the seller for granting this right.
Yeah. The source material notes these instruments are primarily used for three things: hedging an existing portfolio, taking leveraged speculative bets, or generating income.
And for our demographic today, generating income by selling options to collect those premiums is really the sole focus.
It is.
To make this concrete without getting bogged down in ticker symbols, let's look at an analogy.
I love a good analogy.
Think of a financial option like a refundable reservation deposit in real estate.
Okay, I'm with you.
Imagine you are eyeing a property. You pay a small deposit, the premium to the seller, for the right to buy that house at a fixed price of $100,000 within the next 3 months.
Right, so that $100,000 is your strike price, and the 3 months is your expiration.
Exactly. Now, if a new train line is announced and the house value jumps to $120,000, you exercise your right. You buy it for $100,000 and instantly profit.
And if we look at the seller's perspective in that scenario, they are legally obligated to hand over the keys at $100,000, even though the market value is higher.
Because they took your deposit up front.
Right, they absorb that risk.
But if the local economy tanks and the house value drops to $80,000, you aren't going to overpay. Because you have the right, but not the obligation, you just walk away.
You lose your deposit, but you avoid losing $20,000 on the house itself.
Yeah.
Synthesizing this dynamic is crucial. The option buyer pays a premium to lock in a price and limit their downside.
Right.
But the option seller collects that deposit up front and keeps it no matter what happens.
It's theirs to keep.
Exactly.
Bro.
In exchange, they assume the risk of having to sell the asset at a pre-agreed price, kind of capping their potential profit if the market skyrockets.
Now let's scale that up. How does the single deposit concept apply to a massive investment vehicle like a covered call ETF?
It's a great question.
If a regular option is a deposit on a single house, a covered call ETF is like a landlord who owns a massive apartment building.
Right, a whole portfolio of property.
Exactly. They collect normal rent from the tenants, which we can think of as the regular stock dividends. But to boost their monthly cash flow, this landlord systematically sells these purchase option contracts to real estate speculators.
Oh, I see.
The speculators pay a non-refundable fee today for the right to buy those apartments at a fixed price in the future.
Let's break down the mechanics of the word covered in that analogy, because it's important.
Yeah, what does that actually mean here?
Well, the ETF actually holds the underlying portfolio of stocks. They own the apartments, so to speak.
Right.
If the option is exercised by the buyer because the market rallied, the ETF can simply deliver the shares they already hold.
They don't have to scramble into the open market and buy them at heavily inflated prices.
Exactly. They are covered.
So every single month, the ETF looks at its portfolio, writes these call options, and collects premiums from speculators all over the market.
It gathers up those deposits and pays them out to you, the shareholder, as a pretty reliable monthly income stream.
That sounds ideal, but I know there's more to it.
If we connect this to the bigger picture, we have to look at how this portfolio behaves under different market scenarios.
Right, like what happens if the broader market just has a modest rise or, stays completely flat?
In that case, the stock prices never breach that agreed-upon strike price. The options just expire worthless.
Which is good for the ETF, right?
It's great. The ETF keeps the massive pool of premiums, and they keep all the underlying stocks.
So you collect a high yield and your underlying asset value remains relatively stable.
Exactly. It is the equivalent of the real estate speculators walking away. The landlord keeps the fees, still owns the building, and sets up the exact same contracts the very next month.
But what happens in a sharp jump? Like what if we are in a raging multi-year bull market?
Well, if prices shoot aggressively above the strike price, the ETF is legally obligated to deliver those shares at the lower pre-agreed strike price.
Oh, wow.
Yeah. As an investor, you still receive your premium income, and you capture the capital gain up to that strike price.
But your upside is mathematically capped.
You miss out on the explosive rally beyond that point, yes.
Which perfectly summarizes the core trade-off for the investor who is 40 or older.
Right.
You are choosing to gain extra, reliable monthly income and slightly smoother returns, since those premiums act as a buffer during minor dips.
But you are actively sacrificing the full upside in big rallies.
Exactly. You are prioritizing yield and stability over capturing every single percentage point of growth.
Which makes sense. When you are in your 20s, you want total return and compounding growth.
Yeah, time is on your side.
But when you are nearing or in retirement, sequence of risk becomes your biggest enemy. You need tangible cash to pay for your life without liquidating your share count when the market happens to be down.
Here's where it gets really interesting.
Oh.
Because there is a very dangerous misconception out there that covered call ETFs are somehow a totally safe alternative to traditional investing.
Yeah. People see an 8, 10, or even 12% yield. They see the monthly distributions, and they think they found a magic bullet.
Right. If they generate such incredible passive income, what are the hidden costs? Let's scrutinize this.
That is the most critical analysis we can do today. The educational case study methodically outlines 5 main risks that many yield-chasing investors completely overlook.
We definitely cannot just gloss over these.
No, we can't. Risk number 1 is the capped upside we just touched upon.
Right.
In strong bull markets, the total return growth of a covered call ETF will lag significantly behind a plain index ETF. You are literally selling away your upside.
So if the S&P 500 goes up, say, 25% in a year, your covered call ETF might only capture 10% or 12% of that.
Exactly, because the underlying stocks keep getting called away, and the fund has to buy back in at higher prices.
You get your high yield, but you missed out on massive compounding wealth.
Correct. Now, consider risk number 2, limited downside protection.
This is where the safety illusion shatters, isn't it?
It completely shatters. Yes, you collect a premium, but that premium only partially offsets major losses.
So if the broader market tanks by 30%, your ETF is still holding those foundational stocks. The net asset value, or NAV, is going to plummet.
Wait, let me challenge that.
Go ahead.
So we are essentially picking up pennies in front of a steamroller. We get a tiny premium cushion, but if the market crashes 20%, we still take the full hit on the underlying assets.
That is an accurate assessment, actually.
Wow.
The premium might cushion a 2% or 3% drop, but it will not save you from a macroeconomic crash.
And furthermore, when the NAV drops significantly, the fund has a smaller capital base to write options against.
Which means smaller premiums.
Exactly. A smaller capital base generates smaller premiums, which can eventually lead to severe shortfalls in your monthly income right when you need it most.
That leads directly into risk number 3, higher costs.
Right, because these are not passive, set-it-and-forget-it index funds.
Not at all. There are portfolio managers and complex algorithms constantly writing, rolling, and managing option contracts every 30 days.
And the mechanical reality of that active management means significantly higher expense ratios, your MER or TER.
Yeah, it also means substantial internal trading costs. The bid-ask spread on thousands of option contracts really adds up.
Over a long time horizon, that friction heavily drags down your total returns compared to a traditional low-cost index fund.
Which brings us to risk number 4, and this is where I really want you to pay attention.
The tax part.
Yes, the tax implications can be an absolute maze. The educational case study points out that a large portion of that attractive monthly income might actually be classified as return of capital or ROCE.
I want to explain the mechanism behind this because it's confusing for a lot of people.
Please do.
Return capital is not a dividend from profits. It is the fund literally giving you your own original investment money back.
Why would a fund do that?
Because in flat or highly volatile markets, the option strategy might not generate enough pure premium profit to meet their advertised target yield.
So to maintain the illusion of a steady, high payout and keep investors happy, they just dip into the principal.
Exactly. And the consequence of return of capital is that it mathematically erodes your adjusted cost base.
Let's give an example. Let's say you bought the ETF at $50 a share, and over a year, they pay you $2 in ROCE.
Your cost base for tax purposes is now $48.
Right. So if you eventually sell that ETF at $50, you haven't actually made a profit on the share price itself.
But you will still owe capital gains taxes on that $2 spread.
Yes. If you hold these in a non-tax advantaged account, that deferred tax palm can severely impact your long-term wealth.
Which raises an important question about our final risk. Risk number 5, behavioral risks.
Yeah, this one is psychological, but it destroys portfolios just as effectively as high fees.
Imagine watching the broader market soar.
Yeah.
Your neighbors are bragging about their tech stocks doubling.
And you are sitting there watching your covered call ETF stay relatively flat, anchored down by its capped upside.
FOMO sets in.
It really does. Investors get frustrated watching from the sidelines.
They abandon their income discipline, they sell the covered call ETF in frustration, and they buy into the growth index right at the absolute peak of the market.
Or worse, they migrate toward highly complex, leveraged covered call funds trying to juice the yields to 20%.
Taking on catastrophic hidden tail risks in the process.
Exactly. So if you are going to use these tools, you must treat them strictly as income-oriented vehicles with built-in growth constraints.
They are not total return engines.
And they are absolutely not a safe harbor from bear markets. You must define exactly what job you are hiring this ETF to do within your broader portfolio architecture.
So if this strategy mathematically caps our upside and has all these risks, I have to ask, how is this actually being applied in the real world?
Good question. Let's look at the specific case studies provided in the educational case study to see how modern fund managers are trying to solve these inherent problems.
The primary real-world example highlighted is QQQI, which trades in US dollars. This is effectively the covered call version of the popular QQQ, tracking the top 100 tech-heavy companies on the NASDAQ.
And it is engineered to generate high monthly income using a data-driven call option strategy.
But the mechanics of QQQI are what fascinate me.
How so?
They aren't just blindly selling calls and totally capping the upside like older funds used to do.
Oh, right. The research explicitly notes they utilize a spread of purchased options as well.
Can you explain how buying options helps an income fund? Doesn't spending money on premiums eat into the yield they're trying to pay us?
It does require a portion of the premium, yeah, but it is a strategic defense mechanism.
Okay.
A standard covered call fund might sell the right to buy the index at $105, completely capping them at that price.
Right.
But QQQI might take a fraction of the premium they collected and buy a call option further out, say at $110.
So this creates a channel.
Exactly. If the market goes completely parabolic and hits $120, their downside risk is capped between $105 and $110.
But because they own that $110 call, they capture the upside growth from $110 all the way to $120.
It is a calculated structural design to allow for some upside capture in aggressively rising equity markets.
They are basically buying tail risk insurance to make sure they don't get completely left behind in a tech boom.
Yeah. The other massive component of QQQI mentioned in the educational case study is how they handle taxes.
Right. They utilize NDX index options, which are classified by the IRS as Section 1256 contracts.
This is a huge mechanical advantage that we need to clarify.
It is a critical distinction for tax efficiency. Standard options on individual stocks are usually taxed based on how long you hold them.
And because covered call ETFs operate on a monthly cycle, those profits are almost always hit with the highest short-term capital gains tax rates.
But broad-based index options under Section 1256 bypass that entirely.
Right. At the end of the year, they are marked to market, and the tax code automatically grants them a blended rate.
60% of the gain is taxed at the lower long-term capital gains rate.
And only 40% is taxed at the short-term rate, regardless of whether the fund held the contract for a year or just a single day.
For an investor in a higher tax bracket relying on this for income, that 60-40 split is a massive shield against tax drag.
It really is. The strategy is incredibly sophisticated.
The educational case study also briefly notes HDIV as a Canadian counterpart,
Which demonstrates that these advanced active management income strategies are evolving and becoming widely accessible across different global markets and currencies.
So what does this all mean?
When we look at the grand takeaway from this entire educational case study, it really distills down to a mathematical reality.
In practical historical experience, covered call ETFs generally show less total return than the underlying asset they track. That is an undeniable fact.
However, that underperformance is the explicit, conscious trade-off you make in order to receive a reliable, high-yield monthly paycheck.
You are paying a premium in lost growth to acquire the convenience of automated cash flow.
Exactly. You are buying the ability to not have to manually log in, calculate your withdrawal rate, and sell off shares of your core portfolio month after month just to buy groceries.
Which leaves us with a really provocative thought to end on today.
We spent all this time analyzing the math, the taxes, and the mechanics, but think about the psychological comfort of receiving a steady, tangible cash deposit into your checking account every 30 days.
How does that alter your ability to stay disciplined during a market panic?
If you compare a covered call investor to someone who is nervously watching the abstract total return value of a traditional index fund plummeting during a recession.
Having that tangible cash hit your account might provide the exact behavioral anchor you need to prevent catastrophic panic selling.
The math might favor total return, but human psychology might require the monthly dividend.
It is an entirely different framework for valuing an investment. Peace of mind is a return metric that doesn't show up on a spreadsheet.
We really want to hear from you on this.
Yes, definitely.
Please post in the comments below, what is your favorite income strategy for navigating volatile markets? Or if you are looking at this from a lifestyle design perspective, what is your favorite nomadic living city to deploy that passive income in?
Let us know in the comments.
Also, please subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
And don't forget to tune in mid-month, right around the 20th.
Yes, for our monthly income portfolio reveal, we will be sharing major insights and detailed explanations on the specific moves made to optimize stability and income for the upcoming month's distributions.
Thanks for tuning in.
Thank you for joining us for this educational case study.